Good afternoon. There's a couple questions that are going around in the marketplace right now, so surely you're thinking about them as well. One, are we in a housing bubble, and has our market peaked? So the point of this video is to explain to you why we're not in a housing bubble, but our market is starting to stabilize and the prices have peaked. This is the September edition of the Summerlin West 89138 Real Estate Market Update. This is Dale Snyder with the Snyder Group, Team Focused Real Estate, your Summerlin West real estate expert. So let's jump right in. Once again, everybody's talking about the bubble, the real estate bubble here in Las Vegas. So I've got 4 factors of data that I'd like to go through with you that lead me to believe, and I think you will believe after we go through the data, that we are not in a housing bubble. So let's jump right in with point 1. Shazam! So video magic, baby. All right, so here's what we got. Let's go over the Case-Shiller to start. So I've got this document here, which is the Case-Shiller report. You'll be able to get this at the end of the video. Some of you might follow the Case-Shiller. Some of you may not have heard of it before. Basically what it is they take the 20-city composite, the 20 largest metropolitan areas in the nation, and they look at the historic data. So I think that's the first place to start for relevant information. So let's jump right in here. All right, so this is, we're going to go with money, and we're going to go with time down here. This here is the historic housing price trend line. It usually is paired with inflation, about 3 to 5% per year. Let's just do a little sketch here. Take us back down memory lane. Okay, so that probably looks like a bubble here, right? So what happened, 2005-ish, that's when prices were way above the affordability index. And then 2007, 2008, we saw it come crashing down. We're over here today, which is about, according to the Case-Shiller index, we're at about, we've come up, about 30%, maybe 35%. I think as a whole, the valleys maybe come up 26%. It really depends on where we're focusing on, which is Summerlin West right now, which I believe we've come up about 35 or so. I don't have the exact numbers. But point being here is to get back to this trend line of where we should be, we still have approximately 20% to go. So what's important to note from this data is, when I projected this back in 2008, when we started going into the foreclosure crisis, that at some point we were going to see a snapback in the prices. It's just common sense, right? Values went down so much, they were below the the cost to replace that product was just ridiculously low. And buyers pulled out of the market and were waiting. So now we've seen a strong snapback, which we've seen here. But according to the Case-Shiller index, we are the most undervalued housing market in the 20-city composite still to this date. So our price is going to kind of bounce around a little bit, go up and down some. Yeah, absolutely, they could. So, but if you look at the historical data, we are still below that trend line. So if you're looking to sell, you sell above the line, right? If you're looking to buy, it's below the line. So I like to look at data and try to stay non-emotional when I make decisions and when I try to advise clients. In summary of this Case-Shiller analysis, this is kind of the looking over the forest view, right? Historically, this is where pricing has been and where it's going to go. So we've still got a long ways to go here. Even though we've snapped back so strongly, we still have a ways to go. Shazam! It's gone. More video magic. All right, so let's move on to point number 2. Inventory is headed towards stability. And let me explain what I mean by that. So if you look here, you will see historically, we see a healthy, even normal market when we have 5 to 6 months supply of inventory of homes on the market. If we have 1 to 5, we are in a seller's market and we're appreciating. 6+ months, we're in a depreciating market. So that's the generalization there. So let's bring it back here. So what we currently have going on in 89138 zip code is a drastic spike in inventory, which don't be alarmed by that. That's what we should be seeing, right? We went from 16 homes, I think we're up to like 63 today. If you look at the amount of homes we're selling per month in the zip code, and I've ran this back a couple of years, we average about 30 sales per month. So if we're trying to get to stability to where there's an ample supply of inventory and the sellers aren't controlling the market and the buyers aren't controlling the market, that would put us at about 150 homes on the market. We currently have 63. So we've got some room here. You know, we're going to see inventory continue to go up, which is a healthy thing. For sellers that are trying to capitalize on the market, you know, it may not appear to be healthy for you. So let me move into the next section of the inventory and where we're headed. So we all know that inventory is on the rise and expect it to continue to rise. We're also going to be coming into the winter season where we see sales tend to slow down. So what we have, or what we should be expecting, is going to be price reductions. And I want to make one important point here. We've come up about 30-35% in the zip code. And we have sellers that are pricing their homes at 10-15% above the last sale still. What we are going to start seeing is those sellers that really want to sell their homes, they're going to have to start pricing them in alignment with the recent solds. And in some subdivisions, you're probably going to have to go below those comps a little bit because some of them were ridiculously high. So expect price reductions. That doesn't mean we're in a crashing market or a bubble. That just means we're going to see some stability. Another important note here is the average days on market has started to increase. It's taking about 60 days on market to sell a home in the zip code right now. If you look at the solds for the last 30-60 days, it took about 30 days on the market. So be prepared for a little bit more time on the market and, be prepared for a more aggressive pricing strategy when you start to see more model matches and other homes like yours coming onto the market. So in summary with all of this, I wouldn't be alarmed by the inventory coming up. If you are considering selling, or if your home's already on the market, or if you're a buyer, I encourage you to reach out to me. We can have an educated conversation about your specific needs. In conclusion here, point 2 is inventory is leading us to the stability we need to get. We need about a 5-6 month supply of inventory. We're heading in that direction. So don't be alarmed by price reductions and increased inventory. You're just going to have to re-strategize your game plan. So we can help you with that. If you have further questions, feel free to reach out to me. All right, let's move on to point 3. And this is affordability. This is a very important factor. So if we want to look at the 20 city composite, that's going to give us a little bit of an indication on things here. So let's look at the average income compared to the average price point. You can see out of this 20 city composite, which is in the which is in the gray, Phoenix is in the, goldish color. We got LA, I just picked those few. And then we have Vegas in the blue. The affordability balance, and keep in mind, this is where about 30-35% of the average household income is going to be delegated towards the mortgage payment. You can see that we're still roughly, 20% below the affordability index. In fact, out of the 20 city composite, Las Vegas is still the most affordable city to buy a home in. So the other important point about this affordability is when you look at rent versus own. So by looking at this graph here, you will see the 20 city composite, LA, Vegas, and Phoenix. I chose those markets. They're closest to us. We are still our market is still much more affordable to buy than it is to rent. To bring back the affordability here. So if it's affordable right now, and it's cheaper to own than it is to rent, this strong snapback we've seen still makes sense, right? Are we going to see prices slip a little bit? Are we going to see them go up a little bit? Of course. We can't project exactly where that's headed, but if interest rates were to go up a couple of points, we'd still be in that affordability index. If inventory goes up and prices slip a little, or if inventory goes back down and prices go up another 15-20%, we can still stay within that threshold. So I always like to look at the data to indicate if this makes sense. So the affordability indexes and the rent versus own still make sense. All right, let's move on to point 4, which I think is a big point to drive home here. It's the current buyer profile. If you look at our zip code, in the last 90 days, there's been about 100 sales, and I believe 45 or so of those have been all cash. So that's about 40-50% of the homes are closing all cash. In addition to that, I mean, you pretty much have to get a full cavity search to get a loan in today's market. It's pretty insane. So the buyers that are getting loans are putting more money down and they're getting scrutinized to qualify for the loan. During the boom days, the no-doc loans, the liar loans, we had investors doing 100% financing or 95% financing. And as you saw from the Case-Shiller, it was way above the trend line. So if half of the buyers are paying cash, and the other buyers are putting a good amount of money down, are being very, very qualified on the front end to get the loan, that leads to a very stable market. So if you look at it worst case scenario, the prices drop, 10%? Because that's what we've kind of seen cycling for the last couple of years. That's still a very healthy market based on the buyer profile. So let's tie this all together here. We've got several points that I just want to recap on. The bubble. I've gone through all of the indicators and points of why I believe we're not in a housing bubble and leading me to believe we're in a stabilization period. We can go into discussion about Bernanke and the quantitative easing and the shadow inventory and the hedge funds in our market and make this all complicated and convoluted, which I'm sure some of you feel that way if you've been watching a bunch of other videos and Googling and researching. It can be overwhelming. So if you look at the data, which we have done, the Case-Shiller index, leading us to see that we are still undervalued and that it makes sense for the snapback of pricing, that the inventory is headed to stability, and to have 5 to 6 months supply is healthy historically, and to see that price reductions don't mean the market's crashing. It means that, hey, sellers are going to have to get realistic here. They can't keep pushing the market when we've already come up 30. And affordability, it's cheaper to own than it is to rent, and the index shows based on the average income and the average price point in today's market, it's still affordable. And the buyer profile today is a much stronger portfolio of buyers than we saw during the bubble days. Bubble days. All right, whatever. I need to stop using the bubble term. So it's so rampant in our market nowadays. All right, so some of you may be thinking, what about the shadow inventory? What about those hedge funds? What about those investors pulling out of the market? Well, I've done another video about that, so you can click here to further educate yourself and get our pulse on that. Otherwise, I would encourage you to reach out to us to just have a educated conversation on what makes sense for you. When there's shifting in markets, there's opportunity. So is this an opportunity for you, or is this a time for you to hold and wait? Depends on what your position is, buyer, seller, investor. This is Dale Snyder with the Snyder Group, Team Focused Real Estate, your Summerlin West market expert. If you like the video, make sure to like it and share it with others. Have an awesome day.